Hi traders, welcome back. This is Native Day Trader here with another after action report. So today is October 29th and we're going to go over a Google trade. Maybe some of you were in it, maybe some of you missed it, but I want to kind of go over the nuts and bolts of this trade and how you could have made money today. So what we're looking at is a 15-minute chart of Google. Every bar is 15 minutes. And one of the interesting things is I like to play the open. Some people do, some people don't, but I feel that the open is the best time for you to kind of get a feel for how the market is going to be for the day. And by that I mean let's look at how today opened. And we can do that by looking at what I like to call the opening zone. So in order to get the opening zone, we have this blue line is the 20 MA, the green line is the 8 MA, and down here this red line is the 200 MA. So what I like to do is, if we can go right before this bar opened today, we'll look at the opening zone. And the opening zone relatively is going to be from here, yesterday's price action going forward, and the 200 from yesterday. This is your zone right here. Anything in this zone off the open is really not to be trusted, because this is also known as the trap zone in here. So what does that mean? Well, we wait. And we wait. This is the opening bar right here. And if you look very closely at this opening bar, what gets a lot of people tripped up is they look at this and they say, remember when this bar opened, this bar was actually red. See? This bar right here, when it first opened, was red. And it dipped into the trap zone. This is where a lot of people get conflicted because they think, I should buy. It's red. However, if you look closely enough, you'll see that this 20 right down here is your support. Not only that, but that's where the power is. You're trading against position. Position means 20 on top of the 200 and the 8 on top. These are stacked. And trying to go short in this right here is actually trading against position. So, take that off. As I said, this was once red, this first bar here. However, if we look here, we'll see that this turned green. If you fill this in, you actually have a green bar. Right off the open, you have a green bar. That, by the way, pierces through the opening zone. Bam! That is your entry right there. Now, how I would have played it, and the way you should have played it today, you wait until this goes green. Bam! It was red, then it turned green. It went all the way up to here at one point, but then it came back down. That's power. That is a power bar. I'll circle it for everybody. That right there is a power bar. And when you see a power bar like that, what you should do is automatically, you should think to yourself, I need to go long. It kind of drifts back down this way. These are good ad opportunities. Whenever you have a power position, such as the one off the opening bar here, when it drifts down, that is the perfect opportunity for you to acquire more and more and more. Because what ends up happening is right here, when the green removes the red, right there, that's the signal that this could potentially go long even more. And it does. It rips. This stock, Google today, ripped all the way up to here. So let's see. From there, it was 169.45 at the top, 170.75. $1.30. Let's say you had 2 or 3 positions. It's easily $300 right there, almost $400. So how would this trade gone up? Well, in addition, it's not done because we have a double dip right here. We have a double dip down into this here before, again, you have another red get removed by green. That's another add right there. And that key position right there. And then look at it go. From there, it just goes up. So how could we have played this? Well, among many things, here's what I would have liked to have seen. I'll put the opening zone back here again for everybody. Okay. As soon as this bar turns green, we're in. We're in 2 lots. If you want to add, you can add on the red here. You can add here. Or what I would have preferred to have happened is anytime green overtakes red off the open just like that, that's your entry. I would have been in for one more. 1 right there. Bam. 1. So now we're in for 3. What you could have done, if you wanted to, you could have gone out here. 2. Now we have 1 lot left. The second we take profit, what we do is we rotate our stop. You rotate that stop up to right here. Break even. Okay? This is break even for you right here. You are to not violate break even. Now, you got a free trade. So as it comes down here, I would have added another lot here. Now we're in for 2. If you want to do, I would have probably gone out here. Sell 1. Could have added here for, again, another add opportunity here. But I wouldn't have added there. I would have let this go more. Sell another one here. Now you're out completely. And this right here was the play that you should have been in today. That's how you play an effective trade. Let's look at the other opposite side of the equation. Let's look at a stock that was down today. So in order to do that, this is XOM. Exxon. Now this is quite the opposite of Google today. It's actually under its key moving averages. So you had the 200 here today, right there, right? You had your 8 here, and you had your 20 MA right there. Now, how could we have played this to make money today? How could have this possibly worked out? Well, There's a couple ways to do this, but this is probably the most accurate way. On a 15-minute chart, what you should have done first, before the day even begins, draw your opening zone. Opening zone is, I like to go about like a half hour from the previous day, which would have put the 200 right there. Okay. Then I also like to go down to the 20, put my feelers right there. Look at that. That is your, somewhere in there. Okay. Okay. Right there. That's your zone for the day. All right. Now, maybe you saw this one off the 20 and you got in right here. Bam. Right there. Okay. You could either put your stop there or there. Wouldn't mattered because you got stopped out right there. Bam. Okay. That's not good. It happens, but you know what? Such is life. You can't win them all. What I would have done, had you done that, wait. Anything that's under the 200 these days is not to be trusted. What do I mean by that? There's too much space in here. Yes, it could have gone up this way, but the chances are, the likelihood of it going up from here, not very likely, to be doubted, especially in this type of environment that we're in right now. The better play would have been to wait and wait until you got this one right there. Bam! This bar right here is the second break of the opening zone. First one was here, rally back up, but look what it did. It came right back out. Also, this is off a key moving average. This is off the 20 right here. So what I would have done, 2 lots in on this one. You can either play the event or you can go for a 1 bar stop. Either one is acceptable, but this is where your stops should have been. Okay? Then from here, what happens here? Well, as you can see, it drops to here, rallies a little bit up. If you wanted to, you could have added right there for 1. Okay? Always add on the first takeout. So now you're in for 3 lots. If you wanted to, you could have got out here for 2. Rotated that stop loss to break even here. Okay? Or if you wanted to, you could have rotated that stop loss to there. That is your, this right here would have been your new stop right here. Okay? So again, we're in 2 lots here. We add on this one here. 1. We're out here. Rotate the stop here. Wait for it, wait for it, wait for it, out here. Sell the last one here. This is how you play the markets professionally. Okay? This is how you do it. Okay? From here, getting out at around, what was that today? 117.09. If you would have got here, 118.26 relative, so $1.18 move. Okay. On 3 lots, again, this is under $300. On 1,000 lots or 3,000 lots, you know, that's $3,000. But you have to know when to play the market. When do I play this game? How do I play this game? Rule number 1. Let's go over it one last time here. Okay? Before the stock market opens, we create our opening zone. And that's for every stock that you want to trade. And don't have a long list of 30 or 40 stocks, okay? That's amateur hour. Have about somewhere between 6 to 10 and whittle them down from that point. No professional trader has a stock list of 30 or 40. You think you're going to go work for a hedge fund and they're going to say, here's our portfolio list, pick any one you want. That doesn't happen. You're lucky if you get one or two. That is how a professional trader on Wall Street who works for a hedge fund that actually sits on a trading desk trades. They don't have 40 stocks that they cycle through. Because you could be on stock 15 while stock 2 on your list is going parabolic, is blowing up, and then you've missed it. Having a long stock list is detrimental to your development because it ensures that you'll miss a trade or that you're constantly chasing. So instead of that, let the stocks come to you, have a small trading list, and go from there. Okay, so trading zone. Opening zone right here. Here is your 200. Up there, here is your 20. Down here. Okay. This is the zone. This is a zone. Okay. No trades are in the zone right here. We want something either that's going to pop up here or something that's going to come down here. And since we're under the 20, odds are, probability, that it's going to be a short. And sure enough, it was. You could have gone here, but you would have gotten X'd out somewhere around here. Okay? That would have cost you. In order to get away from that, you wait. Wait, all the way, and then hit, attack. Bam, right there. Now we're in for 2. Okay? Come down here. It rallies back up. The moment that this green bar gets eliminated, right there, bam, 1. So now we have 3 lots. A lot's 100 shares. So if you had that, 300 shares right here. It goes down. If you wanted to, you could actually get out here. I would have got out 2. Make sure that we have a profit. Okay? Then from here, your stop, which is either here or here, gets rotated down. Gets rotated down to here. That's your new stop. Now we're at break even. So if this does reverse up here, you still made money, but your stop out will break you even, so you've actually made money on the day. However, this continues to go down here. When it hits here, you're out here for that final lot. You're out right there, and you're out completely. Why? Because you see this space from here to the 20, and from the 20 up to the 200. That is the big spread. When it's wide like this, when your moving averages are wide and your stock is wide from the 20 and the 200, that's when it's time to exit. And if you look, it comes back, and right here is where you should have been. So that's how you trade this market professionally, and this is how you should have traded XOM today. Thank you for watching. I'm Native Day Trader, and I will catch you again tomorrow with another after action report. Until then, keep trading.